Mario Draghi has quite a dilemma on his hands. How to fight deflation in the Eurozone and how to deal with the looming political crisis in Greece, which could end up being forced out of the euro. So can QE save Europe? I want to ask Shahraab Ahmad. He's the Chief Investment Officer and founder of Decca Capital. And our own Bloomberg View columnist, Mark Gilbert, who joins us from London. Shahraab, what's the score in Europe right now?
The market expects them to do QE in Jan 22nd. If they don't, we're going to see an implosion.
What do you mean an implosion?
I love it.
Oh, an implosion. No big deal. What do you mean?
Well, the stock market was down 3%, 2-3 days ago, just on, some Greece headlines. Imagine how we've all set up for this QE to happen June 22nd. For some reason, they don't do it. I think the stock market could be down 10%.
And what about other assets? I mean, a lot of this is priced into sovereign debt.
I think that in sovereign debt it's priced in, but I think, for instance, U.S. Treasuries, you could get a massive flight to quality, right? You've seen on every rally, everyone's been forced to buy more and more of it just to get over their underweight. So I think that's where the biggest impact will be, the U.S. Treasury market.
All right, well, that was 2 days ago. Why is the market up then?
Why was it down, Well,
it was down potentially because people are worried about this implosion you're talking about. So if that implosion is coming, people should have been concerned 2 days ago and today. What's different?
I think basically what this market has done is started taking excuses for everything every couple of months. So in October, we had a big downdraft. Why? There wasn't a particular reason. Same in December. So this volatility that we're all trying to explain, it's not explicable. It's just part of what happens at the late stage of a cycle. The volatility goes up because leverage has gone up and the risks of the market have gone up.
So, Mark, to you in London, Shahraab makes it clear, and other people have made it clear, that the Draghi has effectively painted himself into a corner here, that he has to come out with some kind of quantitative easing in order to satisfy the demand that is built into the prices of sovereign debt and other assets. The question then is how much? How much firepower, does he have to put into this?
Well, he said what he wants. He wants the balance sheet up by €1 trillion, and that's going to be very hard to achieve. His main problem is he's got a Jan 22nd meeting, then there's a Greek election on Jan 23rd. Can he really go and say, I'm going to buy European sovereign debt, when one of the countries in the European sovereign debt pool might no longer be in the Euro sovereign debt pool afterwards? So his timing's tricky. He could just about shade it if he comes on Jan 22nd and says, look, it is coming, I promise it's coming, but we need to get Greece out of the way first. That's the only way he's really going to get out of the corner he's boxed himself into, though. He cannot bluff his way out this time. He bluffed his way out 2.5 years ago. He said he'd do whatever it takes. He hinted he would buy bonds. He never did it. He can't repeat that trick on the market, I don't think. I don't think investors will stand for it this time.
Does he have the ability to do whatever it takes? What does that even mean anymore?
Well, I think the reason he's painted himself into this corner because now it means that Germany has to sign on for QE. At this point, if they don't, then we're going to see a real recurrence of the European sovereign crisis.
So here's another question for you, Shahraab. The argument that Draghi makes for quantitative easing now is that it's what's necessary to prevent deflation. Is it going to work?
Of course not. We've seen it in the U.S., we've seen it in Japan. The first round of QE almost never works. It takes more rounds. So if they do it Jan 22nd, the real economy impact is going to be very minimal. The financial impact will be significant, but we're going to see another round 6 months from now or a year from now of more. It's going to take multiple rounds to make
just like it did here.
Yes.
But unlike quantitative easing here, where only now, or at least only when we arrived at QE3, did people start talking about pushing on a string and whether there was any sense in this. We're already talking about it and they haven't even started.
I think that once they get going, once you've done something for the first time, it becomes easier to make it bigger and bigger. I mean, Japan, the size of what they're doing, we don't even question it anymore. I mean, that's the biggest monetary experiment in the history of mankind.
Mark?
It's tricky. There's not a lot of government debt to buy. You've got to persuade banks that they're going to give up their bonds, take your cash, and do something productive with it in the economy. They haven't seemed convinced about taking central bank cash here so far on that measure. And we're already in deflation. You know, consumer prices fell 0.2% in December. It is hard to unwind that mentality if consumers and businesses are already saying, I don't want to invest because I think it's going to be cheaper. I don't want to buy because I think it's going to be cheaper in the future. Draghi may end up being a day late and $1 short. It's not really his fault. Germany and the Bundesbank wouldn't let him. he's got a very hard task ahead of him. I think that's right.
All right, Shahraab, if Europe really is in this desperate state, how come every single leveraged finance, distressed investor that we speak to says, I've got a whole team in Europe, that's where there's the best opportunity, we're seeing great deal flow? Are these guys all going to get smoked?
I think they're buying a lot of things 50 cents on the dollar. I think they're buying, real covered assets where even if you go into a recession, you're probably okay. We've seen that multiple times. In Japan in the late 90s, everything that you brought from the banks, the economy still sagged, the stock market still sagged, but the private equity guys and the hedge funds that bought a lot of those distressed assets made a killing.
So if, in fact, Draghi goes ahead with what we're talking about, quantitative easing, whether it's 500 million euros, whether it's something north of that, you're an investor, what is he effectively instructing you to do? When that liquidity finds its way into the market, how are you going to respond?
Buy European credit, buy U.S. Treasuries. Those are the two things you buy off of ECB QE.
So European credit is partly what he wants.
Investment grade.
But U.S. Treasury is most definitely not what he wants.
What's going to happen is the banks are going to sell the sovereign assets they own to buy U.S. Treasuries because you pick up 150 basis points of yield. And so if you go from 50
because you're getting the money from the ECB for so cheap.
Right. And the euro is going to go lower. So with U.S. Treasuries, you pick up in yield, you get a stronger currency. What's not to like?
You get a carry trade out of it.
Yeah.
Mark, if that's in fact what's going to happen, it's a complicated transmission mechanism, right? If these banks sell off unwanted assets and buy U.S. Treasuries, somebody else is going to have to step up with the capital. Maybe it's the people that Stephanie was talking about, but the resuscitation, if you will, of the credit market in Europe and the consequent benefit to the economy it's definitely not immediate, is it?
There's a lag, and one of the things that the European Commission is talking about is the need for more infrastructure investment, so actual capital spending. And I think Draghi will make this clear. He said all along, we can do so much, governments have to play their part. You might see a little bit of fiscal loosening going forward. If Draghi's going to make monetary policy as loose as he can, governments can step in, do some spending. There's a lot of austerity fatigue around. That's kind of what we're seeing around the Greek elections. The Greek voters saying in the polls, we maybe have had a little bit too much of austerity. You may see the accompanying of a Draghi QE programme being more government programmes to actually try and boost the growth side of the equation, which, in my view, no bad thing.
Give us probability. What do you think the likelihood is things could really fall out of bed? I'm talking 1987 style crash. If this is February 20th and we're sitting here.
And they haven't done QE?
Correct.
Well, if they haven't done QE, then it's well over 50%. But if they have done QE, obviously it's tiny. But if they haven't done QE, on Jan 22nd, we're going to see a crash.
But then what happens? I mean, that's quite a prediction, and I hope we don't have to talk about it when the time comes. But what if he goes ahead with QE? Is it going to play out for financial markets in Europe the way that it is played out for here, with the Bernanke put and the Yellen put, and that so long as you believe that the central bank is there with more liquidity when the need arises, whenever that comes, then there's every incentive to continue, to buy risk assets. And I guess at the same time, it's complicated, right? Because treasuries have rallied like crazy as well. But you know what I'm getting at.
Yeah, so it's a financial market phenomenon. They do QE, financial assets will rise. The impact on the real economy, uncertain.
Negligible, right.
Do you think QE had real impact on our economy or just the financial market?
3 years later, it did. It took 3 years.
Takes that long. Shahraab, great having you here.
Such a pleasure.